When it comes to dividend investing, it's important to know that dividend investing is a total return strategy. I often hear young or new investors say, why would I invest in that stock for just a 2% yield? That 2% yield is just part of the equation. There's share price appreciation plus the dividend. That equals total return. And you'll hear me often say, never invest based on yield alone. For me, I focus more on dividend growth because companies that have strong free cash flows have the ability to pay safe, reliable, and growing dividends. And when we have companies that are increasing their dividend at fast rates, that puts the power of compounding into overdrive. And in today's video, we're going to be focusing purely on dividend growth stocks and analysts that rate these stocks a strong buy. So make sure you stay tuned throughout the entirety of our video here today. And before we dive in, do me a huge favor, as it really helps with the growth of this channel by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you could check out their 10 best stocks to buy by simply going to fool.com/Mark. All right, let's jump back into our video taking a look at 3 dividend growth stocks all rated a strong buy by analysts. Beginning with dividend growth stock number 1, which is going to be Eli Lilly, stock ticker LLY. And when it comes to Eli Lilly, they are a healthcare giant with popular drugs Mounjaro and Zepbound. However, for those of you that have missed a lot of the gains in Eli Lilly, you're now getting another chance because the stock has been under pressure. The company currently has a market cap of $648 billion. Over the past 12 months, shares are down 25%, and year to date, they're down 10%. The company recently reported their Q2 earnings, which were absolutely fantastic. But those results were overshadowed by one of their late-stage drug trials for their GLP-1 oral therapy, where the results weren't coming in as expected. In the latest quarter, though, the company reported adjusted EPS of $6.31 per share, which blew away analysts' expectations of $5.57 per share. Top-line revenues grew to $15.56 billion, compared to analysts' expectations of $14.71 billion, with U.S. sales growing nearly 40%, with a 46% increase in volume. In addition, this week, Eli Lilly increased their drug prices on popular drugs over in Europe or in UK, as they're continuing to try to balance out the prices in the US and other countries. So was this drop really warranted? I don't think so, and I think this is a great buying opportunity. Let's take a look at this Fiscal.ai chart, for which I utilize for all of my research, and you could try it out yourself for free by using my link down in the description below. But as you can see on your screen, shares of Eli Lilly traded a forward PE multiple of 25.6 times, the lowest we have seen since 2021. This is very favorable to their 5-year average of 41 times. In terms of EV to EBITDA, shares trade at 37.3, also well below their 5-year average of 50.3. Now let's take a look at the dividend, which is right around 1%. But as you can see, they have a 5-year dividend growth rate of 15%, which is what I love to see. In terms of analysts, they rate the stock a strong buy with an average 12-month price target of $937 per share, implying more than 30% upside from current levels. And that leads us to dividend growth stock number 2, which is going to be the Home Depot, stock ticker HD. And when it comes to the Home Depot, they are the largest home improvement retailer in the US, a company that I love to go visit myself, going up and down the aisles, adding things to birthday or Christmas lists, things I probably don't need, but they're on my want list. However, with interest rates being high over the past few years, it has weighed on the stock. But what is on the horizon? What is expected to begin happening maybe as soon as next month in September? Rates are going to start coming down, which could be a pressure release valve for Home Depot. The company currently has a market cap of $398 billion. Over the past 12 months, shares are up 11%. Year to date, though, lagging the market, up only 3%. The pandemic brought a huge renovation boom for homeowners and for Home Depot during that period of time. So that combined with high interest rates put renovations on hold. But with rates expected to come down as soon as maybe next month in September, this could be a pressure release valve for the likes of Home Depot. Now, when it comes to running out and buying shares of Home Depot right now, I want you to be patient because this is a company that reports their latest earnings report next week. And we're going to get a good read on what's expected the back half of the year and how is the consumer doing. We're going to get a read on inflation. We're going to get a read on housing and, as I mentioned, the consumer as well. In terms of valuation, using the earnings they have reported thus far, which are about to change, looking back at our fiscal.ai chart, we could see that the forward PE multiple currently sits at 26 times. This is actually above the company's 5-year average of 21.7. EV to EBITDA is at 17.7 times, also above the company's 15.4 average. So some mixed signals you're getting there from a valuation perspective. But again, remember, these valuations are going to get updated here this week. So we want to be patient with this one. Even though analysts rate this stock a strong buy, which you're going to see here in a second, I do want to be patient and look for a better entry point for me personally. Now let's take a look at the dividend, which currently sits around 2.5% with a 5-year dividend growth rate of 10% and a company that continues to increase their dividend year in and year out. In terms of analysts, as I mentioned, they rate the stock a strong buy with an average 12-month price target of $432 per share, implying roughly 10% upside from current levels. Analysts are upbeat, but I'm going to continue to be patient here, although I love the company. Now let's move on to dividend growth stock number 3, which is going to be Equinix, stock ticker EQIX. Now this, unlike Home Depot, is a stock I'm really excited about right here at these levels. And for those of you unaware, Equinix is a data center REIT. And REITs are historically an interest rate sensitive sector. So over the past few years, yes, the real estate sector has lagged. But as rates start to come down, this is going to have a pressure release valve for REITs. And this has plenty of growth. EQIX, data center REIT. Think AI, another way to invest in AI. When it comes to Equinix, they are one of the largest REITs by market cap, which currently sits at $76 billion. Over the past 12 months, shares are down 6%, and year to date, down 17%. A few months back, shares of Equinix fell rather hard after the company had their investor day, in which the 5-year AFFO growth rate was much less than analysts had anticipated. Here's a look at the slide that management revealed and had analysts and investors up in arms. The fact that AFFO is expected to grow between 5 and 9% per year over the next 5 years just apparently wasn't cutting it. However, this is a company that has continued to deliver 9% AFFO growth dating back for a decade straight. And there's plenty of growth drivers moving forward, catalysts higher for this company, particularly with the growth in AI, which has led to the growth in data centers. I have covered REITs for a number of years, more years than many of these analysts that are putting downgrades on these stocks that they're just not all that familiar with. So this is going to be a video that you're going to want to revisit a year, 2 years from now to see what happens. Let's jump back to fiscal.ai to take a look at valuation. When it comes to REITs, we like to focus on what's called AFFO, or adjusted funds from operations. And as you can see, the company has a forward price to AFFO of 19.9 times, well below the company's 5-year average of 23.5 times. And as you can see from this chart, looking back over the past 5 years, look at the levels that buyers have stepped back in, right around the AFFO multiple that we're currently sitting at right now. When it comes to dividends for REITs, very rarely do you find REITs that are also dividend growth stocks, due in fact to the qualifications in order to become a REIT. But when it comes to Equinix, they have bucked the trend, as they currently have a dividend yield of nearly 2.5% and a 5-year dividend growth rate of nearly 12% on nearly a decade straight of dividend hikes. In terms of analysts, they rate the stock a strong buy, with an average 12-month price target of $955 per share, implying more than 20% upside from current levels. So there we just looked at 3 dividend growth stocks, all rated strong buys by analysts. We looked at a healthcare company, we looked at a retail company, and we looked at a REIT. Down in the comment section below, let me know which of these 3 stocks do you believe is the strongest buy at current levels. And if you haven't done so yet, please hit that like button down below. It really helps the growth of this channel, and I truly appreciate it. Thanks again for watching, and we'll see you in the next one. Take care.